Have you invested in the stock market? If yes, then congratulations. Today was a good day for you. Go ahead and check your portfolio. In the last 2 days, Indian markets have scaled new highs. Both Nifty and Sensex hit all-time highs. The Sensex topped the 67,000 mark for the first time in its history. The Nifty reached 19,811. Both are record numbers. So tonight, we're looking at 3 questions. 1, what is driving this rally? 2, should you be investing now? And 3, what does it say about India's economy? First, let's understand the rally. It's been building up for quite some time. Since late March, the Indian markets have gained more than $600 billion. The Sensex is up almost 15%. So the momentum was there. But where did that momentum come from? Foreign investors, they are pumping big money into Indian stocks, around $16 billion since April. That's around $1 billion per week. India has become the largest recipient of foreign investment among emerging markets. What explains the sudden interest? Well, for starters, there is a slowdown in China. After the pandemic, investors were selling in India and buying in China, but now it's the opposite. They're selling in China and buying in India, hence the rally. Another reason is the earnings reports. Indian companies are publishing numbers for the first quarter. How much they sold and how much money they made. Sort of like a progress card, a report card. The assumption is it will be good. India's consumer confidence has reached pre-pandemic levels. People are buying, people are traveling again, so companies should be doing well. These 2 factors are pulling up the Indian markets. It also helps that the global stocks are in the green. Overall, world markets are at a 15-month high. They're expecting some good news from central banks. You see, inflation has largely eased off. Let's in fact look at US inflation, for example. In America, inflation was 9.1% in June last year. This year in June, it fell to 3%. That's the lowest US inflation in 2 years. The Federal Reserve will be watching this closely. That's America's central bank, the Federal Reserve. They have been hiking interest rates to battle inflation, but now could be the time to pause. Maybe let the economy breathe a bit. If that happens, the markets will love it. So to sum up, there are 3 big reasons for India's stock rally: more foreign investment, hopes of good earnings, and global momentum. Now to the second question. Is this a good time to buy? Absolutely not. Experts have warned of a correction pretty soon. What does that mean? Well, think of this rally as adrenaline. When it pumps through your body, you're raring to go. You're more alert, more energetic. But what happens when it disappears? You lose the energy. This rally is a bit like that. Yes, there is a lot of global interest in the markets, but even then, these levels are way too high. So expect some volatility soon. Plus, a lot of people will be looking to sell at these levels. And why not? It's a good time to book your profits and leave. Just one problem though. When so many people sell, it will drag the markets down. So don't think about investing right now. You can't make much money at these levels, which brings us to the final question. What does it say about India's economy? Let me give you a disclaimer first. I know the markets are often shown as an indicator of economic health. And they are an indicator, but not a perfect one. The markets are a bit like over-enthusiastic parents. They love their children, so they bet on them. The best schools, the best tuitions, the best technology, and sometimes it works. The kids go on to become successful, but sometimes their interests are elsewhere, maybe in music and not academics. In such cases, the investment backfires. Do you see what happened here? The parents made a decision based on their sentiment towards the child, not necessarily skills or interest, but sentiment. The same often happens in the stock market. Investors place massive bets on countries only to lose money. Is that what's happening in India? Well, not from the looks of it. India is expected to be one of the fastest growing economies this year. Rating agency Fitch upgraded the GDP forecast last month. It was initially 6%. It is now 6.3%. So all the ingredients are very much there. Inflation is under control. Industrial output is rising and forecasts are good, which is why many investors look at India as a bright spot. Yes, there is some sentiment and speculation involved, but it's also backed by hard numbers. So the stock rally is like a vote of confidence from investors. They are betting on India. They're positive about the India story. It's the government's job now to repay that faith, to use this pandemic recovery period to make real gains. If not, this rally will fizzle out, and along with it, the sentiment. Do you know what's trending today? The boom in India's stock markets. The bulls are leading the way. Key indices are breaking records. We'll discuss all of it later in the show. But first, we want to tell you who may be feeling left out. China. Once the engine of the global economy, China today is a laggard. Its economy is pulling down global growth. And it's not just China's problem, it's your problem too, because Beijing's poor economic performance has a bearing on all of us. Tonight, we bring you the numbers, the trends and the implications, starting with the latest set of data. Today's headlines featured Evergrande. It's a Chinese property giant. It has been in news for all the wrong reasons lately. Today, it reported more losses. We are talking about losses worth $81 billion. $81 billion in 2 years. Evergrande has been in financial trouble for a while now. The company lost $66 billion in 2021 and another $15 billion in 2022. It defaulted 2 years ago. Before that, it was China's biggest developer. Today, it is one of China's worst debtors. By last year, the company owed some $340 billion. Since 2021, Evergrande had not released its financials. Today, they finally did. And it revealed how deep the rot is. The fall of Evergrande triggered a major churn in China. It inflicted some serious pain, and it had a ripple effect on China's property sector, on its banks, and on its economy. 50 developers defaulted, 50 developers defaulted after Evergrande, and since the Evergrande collapse, China has been stumbling from one problem to another. Yesterday, they released the latest economic data. China's economy grew by just 6.3%. It doesn't sound like a very bad figure, but it's slower than what had been expected. China's exports fell by 12% last month. Sale of flats down by 27%. These are poor numbers. They suggest that China's economic growth has stagnated. Although yesterday Beijing tried to put a different spin. They tried to push a different narrative. Listen to this.
Although the Chinese economy faces increasingly complex and challenging external environment and domestic development pressures, its fundamental strengths and its advantages characterized by resilience, great potential and vitality remain unchanged for the long term.
There are challenges, but the economy will recover. That's the message from Beijing. China is making it sound like there is no reason to worry. But behind the scenes, Chinese officials have gone into an overdrive. They're talking to the US again. In 1 month, China has hosted 3 senior American officials. In the next 2 weeks, Chinese ministers will travel to Washington. And guess what's on the agenda? Trade ties. Plus, China's premier is making fresh overtures. Recently, Li Qiang addressed business leaders. His message to them was simple. China is open for business.
For the whole year, we are expected to achieve the target of about 5% economic growth set at the beginning of this year. Recently, some international organizations and institutions have also raised their forecasts for China's economic growth this year, showing their confidence in China's development prospects.
This was last month. Now the numbers are out and they're well below China's targets. This year, Beijing wanted to grow at 5%. But from April to June, China's economy grew by just 0.8%, which is less than the 1% mark. At this pace, Beijing is sure to miss its targets. And it seems to be asking for help. This week, there is another important meeting. China has invited some of the world's biggest investors. And who will meet them? China's financial regulators. The goal is to seek investments. And who is going to attend the meeting? Well, mostly fund managers from large private equity firms, also some representatives from sovereign wealth funds. There is no official guest list, so it remains to be seen who will finally turn up. But here's the bigger question. Can investor summit solve China's problems? Experts don't think so, because China's economic problems are more fundamental in nature. The debt levels are way too high, more than 250% of the GDP. That's higher than even the US. There is weakness in real estate, unemployment is high, and sanctions from the West are forcing businesses to take their investments elsewhere. These factors are exerting pressure on the Chinese economy. Until Beijing fixes these problems, there can be no recovery. Financial boom or not, one group always thrives: business leaders. It's a big contradiction of the corporate world. Job cuts for ordinary workers, million-dollar bonuses for CEOs and directors. Try making sense of that. If there is a financial downturn, shouldn't everyone be affected? Well, technically, yes, but in practice, that's not what happens. And why am I talking about this today? Because for some bigwigs, the game is up. Directors at Tesla have settled a lawsuit with their shareholders. Guess how much they're paying? $735 million. The directors will return this money to the company, $735 million. The question is why? Because they overpaid themselves. From 2017, these people awarded themselves around $11 million in stock options. The shareholders caught on to it. They filed a case saying the compensation was too high, and now Tesla has settled. The company won't say why, but court documents say the directors are acting in good faith. Sure they are. What's $700 million over good faith? Elon Musk himself is fighting a similar case. He awarded himself $56 billion in stock options, $56 billion, and that too is being challenged by shareholders. But our story tonight is not just about Tesla. It's about every company out there. Why are CEOs and directors paid these ridiculous sums of money? And why in the middle of job cuts? First, let's look at some numbers. CEOs of American companies are paid around $27 million. That's salary plus stock awards. And this is 399 times more than what average workers earn. 399 times. This gap was not always so high. In 1965, CEOs earned 20 times more. In 1989, 59 times. So what changed after that? Well, in the West, it was a time of economic churn, the 1980s. Governments in the US and the UK cracked down on labor unions. They put more emphasis on the free market, so naturally the gap widened. Another reason was the fall of businesses owned by families or individuals. In their place, shareholders appeared. Now, shareholders are more demanding. They want to see instant results. They want to see profits. So what did board members do? They agreed to pay CEOs more. The assumption was this would drive the company forward, which brings us to present day. High-paid CEOs are a reality of today. Supporters say, let the market decide salaries. If businesses are willing to pay millions, surely they must be worth it. But critics say otherwise. They claim not every CEO is an industry titan. Some of them are piggybacking on other factors like a great tech team or a booming industry or maybe a tax cut. Either way, the payment is ridiculously high and it doesn't change even during bad times. Let's look at some of the big companies now. Meta laid off 10,000 people this year, plus 11,000 late last year. But the same company gave six-figure bonuses to senior executives, not salary, bonuses. Netflix laid off around 4% of their workforce last year. Their CEO has a bonus worth $14 million. Same with Google. They laid off around 12,000 of their employees. That's around 6% of their workforce. But guess how much CEO Sundar Pichai took home? $226 million last year. How do companies justify this contradiction? The argument is the CEOs are highly skilled, that their intellect is key to the company's growth. But if you're firing thousands of people, clearly the company is not growing, yet no accountability. Just think back to the 2008 financial crisis. American banks were headed by the best of the best. And what did they achieve? They plunged the entire world into recession. Tens of thousands of people lost their jobs, but again, no accountability. In fact, they were rewarded. The US government had to spend billions of dollars to bail out American banks. And guess what these banks did with that money? They paid bonuses. 5,000 of the top bankers got $5 billion in bonuses. Tells you where the problem is. There is no scrutiny or independent oversight. Most CEO packages are decided by compensation committees. And who is part of these groups? Board members and executives from other companies. It's like asking actors to rate their own movies. Obviously, it will be 5 stars. So what we need is more transparency, more logic to these numbers. I'm not saying CEOs should earn the same as other workers. They do bring in valuable expertise. They should be paid more than average workers. But how much more is the question? Surely 400 times is too much. Our next story is about a particular kind of pain. It is known to nearly every person who has ever held a job. The tyranny of tedious meetings. Many call pointless meetings mind-numbing. Some say they're soul-sucking, even torturous. While the same old jokes are criminally repeated, intense boredom reigns supreme, minutes are made and several hours are lost. But that's not all. Remember the age-old maxim, time is money? Well, a study says that's true for meetings as well. Unnecessary meetings do not just waste time, they also waste money, and they cost big companies $100 million every year. Firms are slowly waking up to this fact. The latest among them is a Canadian company, an e-commerce platform called Shopify. It has started putting a price tag on meetings. The company uses a special calculator which is embedded in each employee's calendar app. It uses an average salary of the employee's role, the duration of a meeting and its attendee count. Then it estimates the cost of these meetings. A typical half-hour meeting costs anywhere between $700 and $1,600. But put a senior executive to the mix and the cost shoots above $2,000. Can you imagine your company treating you to a $700 dinner? The chances are slim, but that's how much they casually spend on a useless meeting. Now, I'm not saying all meetings are bad. Sometimes they are essential, important for exchanging thoughts or making plans or reviewing progress or setting agenda. But more often than not, meetings steer in the opposite direction. They fail to achieve the goal they set out to. They're tiresome, stretched out without reason, inconsequential, unproductive. Yes, useless meetings don't just rob companies of money, they also take away your productivity and joy. A study calls them one of the top 5 causes of inefficiency. Another study says that bad meetings reduce communication and collaboration. People's happiness at work takes a hit. But you don't need a study to know all of this. Useless meetings are a shared human experience and it seems like everyone hates them. How many times have you thought to yourself that this meeting could have been an email? Well, you're not alone. And I believe the kids are calling it meetingitis. It's when unnecessary meetings are held excessively, and lately they've become more common than ever. Meetings have increased in frequency over the past 50 years. Executives spend about 23 hours a week in them. That's up from less than 10 hours in the 1960s. The pandemic only made it worse because in-person interaction was limited. A Microsoft report agrees to this. Since the start of the pandemic, the number of meetings increased by 153% globally. Companies see this. For decades, they've tried to make meetings relevant. Like in 2006, Ford Motor slashed unduly long meetings. In recent years, other companies have tried to get more creative. Some have introduced a no-meeting day every week. Microsoft has a no-meeting Friday. 73% of their employees say it is good for them. 77% say it helps them focus. Canva, the software company, introduced a similar rule, a no-meeting Wednesday. And experts say this helps too. It improves communication, engagement, and satisfaction because all meetings are not problematic. Sometimes, meetings can elevate voices. They can give someone a seat at the table. It's the so-called bad meetings that cause the problem. When they don't have a real purpose, when they run too long, or when they have too many attendees. Studies say workers usually don't need to be in 1/3 of the meetings they attend. So why are they there? For many, entire careers are made up of planning, holding and attending such meetings. Yet no one dares to question them, perhaps because it's a workplace norm. Some are afraid of offending a senior. Some suffer from FOMO, that's the fear of missing out. But this culture needs to shift. What is the point of unnecessary meetings? Only to scratch some kind of managerial itch or to seek respite from desk-bound loneliness? Maybe it's time to end this meeting madness. Now it's time for Vantage Shots, images that tell the story. China has been hit by Typhoon Talim. Heavy rain created a waterfall on a busy road. Meanwhile, wildfires are burning in parts of California and the United States. We'll show you a time-lapse video of its progression. And Indian cricketer Mahendra Singh Dhoni is famous for his decision-making prowess on the field, but you know he's also a huge bike and car enthusiast. Former Indian cricketer Venkatesh Prasad shared a video of Dhoni's impressive automobile collection. And finally, we're taking you back in history on this day. In 1947, the Indian Independence Act was cleared by the British monarchy. This act divided the subcontinent. It created two new independent nations, India and Pakistan. It also declared India as a sovereign and independent state. We're leaving you with that. Thanks for watching. We'll see you tomorrow.
Any comments on this?
Unless and until someone is mad about this, you can't.
I'll take a video.
Isn't it? Huh? She was not making it for me. Doesn't it look weird? All these पता नहीं ये बाइक शोरूम हो सकता है ये.
बेसिकली जब ये बन रहा था ना तो हम लोग बहुत बड़ा बना.
Yeah, it's full. It's full.
ये बना था